The trading floor is in chaos. Screens flash red across Seoul as South Korea's stock market tumbles at record speed. What just weeks ago was a euphoric Russian, unprecedented surge fueled by artificial intelligence and tech optimism has been decimated in hours. Investors stare at numbers that erase billions of dollars as the won collapses to its weakest point in nearly 17 years against the US dollar. Samsung Electronics, SK Hynix, Hyundai Motorol titans of the Korean economy are bleeding value. Their once bright stock charts, now a cascade of deep crimson. The trigger? Rising fear of a widening war in Iran, a geopolitical shockwave rippling across global markets. Oil prices spike, supply chains tremble, and the world watches in suspense as one of Asia's most dynamic economies teeters on the brink. For South Korea, a country whose economic lifeblood flows through technology and exports, this is not just a financial story. It's a national crisis, a high-stakes drama where every tick of the market feels like a pulse of the nation itself. Tonight, we unravel how AI optimism, soaring stock valuations, and global geopolitical tensions collided to create one of the most dramatic market reversals in decades. Why did South Korea's investors, once riding the wave of AI-fueled gains, suddenly face such devastating losses? And what does this turmoil mean for global investors, for everyday Americans exposed indirectly through markets, and for the future of AI-driven speculation worldwide? Stay with us as we dissect every angle, timeline, and consequence in this investigative report. This is not just numbers on a screen, it's the story of fear, technology, and uncertainty unfolding in real time. To truly understand the scale of South Korea's market meltdown, we must first rewind to the extraordinary surge that preceded it. Over the past 18 months, South Korea had become a global epicenter of AI-driven investment enthusiasm. Retail investors, institutional funds, and even tech startups fueled a fevered rush into companies promising artificial intelligence breakthroughs, from semiconductor giants like Samsung Electronics and SK Hynix to AI-powered software firms and robotics innovators. Reports suggest that speculative trading reached levels not seen since the dot-com bubble, with the Kospi index climbing relentlessly, driven not solely by earnings but by a collective belief in South Korea's technological supremacy. At the same time, the nation's broader economic landscape amplified this euphoria. South Korea had recently weathered global supply chain disruptions with relative resilience, boasting strong exports, record corporate profits, and an unemployment rate that was at historic lows. AI was no longer just a buzzword, it was becoming a national emblem of future growth. Analysts widely reported that investor sentiment was sky-high, with retail traders often young, tech-savvy individuals pouring savings into high-risk, high-reward AI-related stocks. Social media platforms were abuzz with tips, predictions, and moonshot speculation, reinforcing a sense that the market was unstoppable. Yet, even in this age of digital optimism, history reminds us that markets are fragile. South Korea sits at a crossroads of geopolitical sensitivity. Its proximity to major energy routes, reliance on global trade, and position in international tech supply chains make it acutely vulnerable to external shocks. This is where the tension with Iran enters the picture. For decades, Iran's geopolitical posture has influenced global oil markets, regional security, and investor confidence worldwide. Recent escalations, reports suggest, have raised fears of a broader conflict that could disrupt energy supplies and international trade flows. For South Korea, an energy import-dependent economy, such a scenario is not abstract. It is an existential economic risk. The convergence of these foresees a euphoric AI-driven stock market and a suddenly precarious geopolitical landscape, created the perfect storm. While investors were riding a wave of unprecedented optimism, the underlying vulnerabilities were mounting silently. Now, as Iran-related war risks dominate headlines, the consequences of ignoring these structural risks have become brutally clear. This backdrop sets the stage for understanding why South Korea's AI-fueled market boom unraveled so rapidly, why losses were so steep, and why the implications extend far beyond Seoul's trading floors. The collapse was sudden, brutal, and unrelenting. On the morning of March 4, 2026, South Korea's Kospi index opened sharply lower, immediately triggering concern among traders. Within the first hour, the benchmark index had plummeted nearly 6%, a staggering drop in a market accustomed to steady, incremental movements. By mid-morning, reports confirmed that the Kospi had fallen nearly 12%, prompting the Korea Exchange to implement emergency circuit breakers, temporarily halting trading to prevent panic-induced liquidation. Investors were left watching in disbelief as corporate giants, once pillars of stability, were hammered mercilessly. Samsung Electronics, the crown jewel of South Korea's technology sector, saw its market capitalization slashed by tens of billions of dollars in mere hours. SK Hynix, another semiconductor titan, reported losses exceeding 15% of its stock value on the day, while Hyundai Motor, a barometer of industrial strength, tumbled in tandem, reflecting both market panic and fears of disrupted supply chains due to potential global conflict. Financial analysts suggest that in just 2 trading sessions, the South Korean market lost hundreds of billions of dollars in total market value, erasing months of gains fueled by AI hype and investor optimism. The currency market mirrored this upheaval. The South Korean won plunged to its lowest level in nearly 17 years against the US dollar, compounding losses for companies with dollar-denominated debts and investors holding foreign assets. The sudden weakness of the won heightened the cost of imports, particularly energy, intensifying fears that the crisis could spill over from financial markets into the broader economy. Behind the numbers lies a chilling timeline of events. According to verified reports, the sell-off began with escalating Iran war fears, triggered by military movements and diplomatic tensions in the Middle East. Oil futures surged sharply, with Brent crude reaching multi-year highs as traders anticipated potential supply disruptions. This, in turn, amplified investor anxiety in oil import-reliant economies like South Korea, where energy costs directly affect industrial output, manufacturing margins, and household consumption. Statements from key market participants reflected the gravity of the situation. A senior fund manager at a leading Seoul-based investment firm told Reuters, "We were riding a wave of AI optimism for months, and suddenly the external shocks reminded us that markets do not exist in isolation. Everything can change in an hour." Government officials, while refraining from predicting further market movements, issued reassurances that financial authorities were monitoring volatility and prepared to intervene if necessary. The sell-off also rippled beyond South Korea. Regional markets in Japan, Taiwan, and Southeast Asia experienced sharp declines, with investors globally reassessing exposure to tech-heavy Asian equities. Reports suggest that this shockwave was part of a larger, interconnected global response to rising geopolitical instability, demonstrating the fragility of markets that had been riding speculative tech surges. In short, what had been a celebration of AI innovation and tech-fueled growth turned into a stark reminder of the vulnerability inherent in hyper-optimistic markets facing global uncertainty. South Korea's euphoria unraveled, and with it, billions of dollars of investor wealth evaporated almost overnight. To understand the full magnitude of South Korea's market upheaval, it's essential to examine the expert perspectives shaping both interpretation and response. Financial analysts, economists, and geopolitical strategists alike are calling this a textbook example of how intertwined technological exuberance and global risk can collide with devastating consequences. From a financial standpoint, experts stress that the AI-driven surge in South Korean equities created a market highly sensitive to external shocks. Dr. Lee Sang-hoon, a senior economist at the Korea Development Institute, explained, "The market had been trading on expectations rather than fundamentals. Valuations were elevated, particularly in the AI sector, and any geopolitical disruption, especially in oil and energy markets, was always going to be a trigger for correction." Reports suggest that retail investors, many of them first-time participants drawn by AI hype, bore the brunt of the losses, compounding social and political pressures on financial regulators. Legally, the rapid deployment of circuit breakers and trading halts has attracted scrutiny. While these mechanisms are designed to prevent panic selling, Some market commentators argue that they may delay necessary market corrections and inadvertently intensify anxiety. Circuit breakers give time for information to be digested, but they don't remove the underlying risk, said Park Ji-won, a Seoul-based market lawyer. In cases like this, where the trigger is geopolitical, the solution is not purely financial. It's fundamentally tied to global risk management. From a political angle, the market reaction underscores the fragile intersection between domestic economic stability and global diplomacy. South Korea, a technology powerhouse and crucial U.S. ally, finds itself navigating heightened tensions over the Iran conflict. Analysts suggest that any escalation in the Middle East threatens not just energy supply chains, but also investor confidence worldwide. Policy advisors are reportedly urging caution, highlighting the dual imperative of maintaining market stability while preparing for potential international ramifications. The financial impact extends beyond stock markets. South Korea's currency plunge directly affects import costs, particularly oil and energy, which in turn impacts industrial output and inflation. Reports indicate that consumer goods prices may rise, potentially slowing domestic consumption and widening the economic fallout. Experts warn that unless volatility is carefully managed, the ripple effect could extend to Asia-Pacific trade partners and even global markets, given South Korea's integration into international supply chains. Public and media reaction has been equally intense. Social commentary highlights the anxiety experienced by retail investors, many of whom had embraced AI stocks with youthful optimism. Media coverage has framed the collapse as a stark lesson. Technological promise can drive unprecedented gains, but without robust risk assessment, it can just as swiftly precipitate a financial crisis. In essence, the expert consensus is clear. The South Korean market turmoil is not simply a reaction to AI overvaluation or a singular geopolitical event. It is the product of complex systemic vulnerabilities, elevated investor sentiment, global interconnectivity, and geopolitical uncertainty, intersecting in a high-stakes environment where human emotion, technology, and world politics collide. As the markets plunged and the won collapsed, social media erupted into a whirlwind of speculation, outrage, and analysis. Twitter feeds, Reddit forums, and financial Discord channels became real-time pressure valves for investors desperate to process the chaos. In South Korea, hashtags like Kospi crash, AI stock meltdown, and one weakness dominated trending topics, drawing not just local attention but global eyes from traders, journalists, and economists monitoring the fallout. American investors, many with exposure to ETFs or multinational companies tied to South Korean tech, quickly joined the conversation. Analysts at Bloomberg and CNBC reported that retail traders were scrambling to assess the implications for portfolios. Tweets flooded in with a mix of fear and anger. "All those AI moonshots gone overnight," read one viral post, while another captured frustration with blunt clarity. 17 years of one's strength wiped out in hours. How did no one see this coming? On Reddit's r/investing and r/stocks, discussions quickly evolved into debates over AI overvaluation, global geopolitical risk, and the sustainability of speculative bubbles. Some users drew parallels to historical crises, referencing the 1997 Asian financial crisis and the dot-com collapse of 2000, while others focused on the modern twist: retail-driven, AI-fueled speculation amplified by social media itself. Analysts report that this digital amplification heightened market anxiety, as real-time narratives of panic and loss circulated faster than official news sources could respond. The cultural impact extends beyond the financial community. Memes depicting AI robots crying over lost stock gains, viral TikTok clips dramatizing market crashes, and YouTube explainer videos with titles like "AI Dreams Shattered in a Day" indicate that this event has seeped into mainstream consciousness. According to analytics from CrowdTangle and social media monitoring firms, engagement on posts related to the South Korean market collapse has already surpassed millions of interactions globally, underscoring how intertwined financial news and digital culture have become. The divide in sentiment is striking. On one side, veteran investors emphasize prudence, citing this as a cautionary tale of over-leveraged optimism. On the other, a younger generation of traders expresses disbelief, anger, and a sense of betrayal, questioning regulatory safeguards and the wisdom of AI-driven speculation. This tension has sparked heated discussions on policy, investment strategy, and the ethics of tech-driven market hype. In short, social media has turned the financial meltdown into a living, breathing narrative. It's no longer simply numbers on a screen. It's a human story of hope, risk, and the global reverberations of one day's market chaos. Americans and global audiences alike are participating in a collective conversation, blending factual reporting with emotional response, creating a digital echo chamber where fear and curiosity amplify every fluctuation. The South Korean market collapse is far more than a fleeting headline. It carries profound implications for investors, corporations, and the broader global economy. Financial strategists and economists are warning that the AI-fueled euphoria that drove the surge may now be subject to a prolonged reassessment. Companies that once rode speculative waves of investor optimism must confront the stark reality. Market confidence is fragile, and technological promise alone cannot insulate against geopolitical shocks. For investors, the lesson is immediate and visceral. Risk management strategies are being revisited across the board, with analysts advocating for more diversified portfolios that hedge against sudden geopolitical escalations. Retail investors, in particular, face the challenge of recalibrating expectations in a world where social media-driven hype can rapidly inflate and just as quickly implode valuations. Reports suggest that several major investment firms in Seoul and New York are already reassessing exposure to AI-heavy South Korean equities, anticipating continued volatility in the coming weeks. From a corporate perspective, companies like Samsung Electronics, SK Hynix, and Hyundai Motor are under pressure to stabilize both their stock prices and their operational resilience. While earnings remain strong, investor confidence is now tightly coupled with global stability. Firms may need to reconsider supply chain strategies, energy procurement, and international partnerships to insulate against external shocks, particularly those originating from geopolitical hotspots like the Middle East. Politically and geopolitically, the collapse highlights the vulnerability of highly integrated economies to global events. South Korea's dependence on energy imports and international trade has made it particularly sensitive to war risks in Iran. Analysts suggest that government authorities may implement new safeguards, from financial market interventions to policy measures aimed at mitigating energy price shocks. Similarly, foreign investors and policy advisors are likely to pay closer attention to geopolitical developments when assessing emerging market exposure. The broader industry impact cannot be overstated. Tech and AI companies worldwide, inspired by South Korea's meteoric rise, may now face stricter scrutiny from investors wary of similar speculative bubbles. Reports suggest that venture capital firms may slow investments into high-risk AI startups, focusing instead on measurable performance and regulatory compliance. In essence, the AI gold rush may enter a new phase, tempered by caution, skepticism, and heightened awareness of external vulnerabilities. Finally, the long-term implications for the global economy are substantial. South Korea is not an isolated market. It is deeply integrated with global supply chains, international tech ecosystems, and investment networks. Prolonged volatility could ripple across Asia-Pacific markets, influence currency exchange trends, and even impact U.S. and European investments indirectly exposed to Korean tech companies. Analysts caution that what may appear as a regional disruption has the potential to shape investor behavior and corporate strategy globally, signaling a pivotal moment in how markets balance technological innovation with geopolitical risk. In short, the AI-fueled euphoria has been replaced with a sober reassessment of risk, resilience, and the delicate interplay between technology, investment, and world affairs. For those watching closely, from Seoul to New York, this moment is a stark reminder. The future of AI-driven markets is exhilarating, but never immune to the unpredictable forces of geopolitics. Beyond the numbers, charts, and headlines lies the human story of loss, anxiety, and uncertainty. For thousands of retail investors across South Korea, what had been a hopeful investment in the promise of AI technology has suddenly become a source of fear and personal hardship. Young professionals, many in their 20s and 30s, invested significant portions of their savings into tech stocks, lured by soaring valuations and promises of exponential gains. Now, reports suggest they are confronting a financial reality that could impact everything from student loans to housing plans, marriage prospects, and family support obligations. Families across Seoul and Busan are feeling the shockwaves firsthand. Parents who encourage children to invest in the future now watch anxiously as their children navigate margin calls and stock losses. Household conversations, once optimistic about AI-powered prosperity, have shifted to debates over emergency funds, economic safety nets, and whether speculative investing is worth the risk. Psychologists note that this type of market panic, amplified by social media and instant news cycles, can cause emotional stress akin to real trauma, especially for younger investors who have limited experience with financial volatility. Employees at the companies most affected, Samsung, SK Hynix, Hyundai, and countless AI startups, are also caught in the crossfire. Reports indicate that stock-based compensation and bonuses,